Right now, today, in March of 2026, there is a number sitting inside a government report that almost nobody in mainstream media is talking about. That number is 11.52%. That is the current FHA delinquency rate in America as of Q4 2025. 1 in 9 FHA borrowers in this country is behind on their mortgage. And I want you to stop for a second and really absorb what that means, because this isn't a statistic from the middle of the 2008 financial crisis. This isn't a relic of the foreclosure wave. This is right now. But here's the thing, that number, as alarming as it is, isn't actually the story. It's the warning signal. And if you're a homeowner, a buyer, a seller, or even someone who's just watching this market from the sidelines, trying to figure out when to move, you need to understand what comes after that warning signal. Because historically, what happens to FHA borrowers today reaches every other borrower somewhere between 12 and 18 months later. The pipeline is filling, the data is moving, and the people who understand what's inside these numbers right now are going to be in a completely different position than the people who find out about it later. So today, that's what we're going to do. We're going to walk through exactly what is happening, why it's happening, where it's happening, and most importantly, what you should actually do about it based on your situation. Let's get into it. Let's start with the big picture, because the FHA crisis doesn't exist in a vacuum. It's the sharpest edge of something much larger that's been quietly building for over a year. The Mortgage Bankers Association released its Q4 2025 National Delinquency Survey in February of this year. Here's what was in it. The overall mortgage delinquency rate across all loan types hit 4.26%, up 27 basis points in a single quarter. That doesn't sound dramatic until you understand what's driving it. Conventional loans up 27 basis points to 2.89%. That's elevated, but still relatively contained. VA loans up 10 basis points to 4.60%. Worth watching. But FHA loans, FHA jumped 74 basis points in a single quarter to reach that number. I opened with 11.52%. That is the highest FHA delinquency rate since the second quarter of 2021. And here's what makes that number truly alarming. When you dig deeper, it's not the early stage 30-day delinquencies that are surging the most. Those actually held relatively flat. What exploded was the 90-day plus bucket, serious delinquency, up 76 basis points in a single quarter for FHA borrowers. That means people who are not just a little behind, people who are deeply, structurally struggling. The FHA foreclosure inventory rate now at its highest level since the first quarter of 2020. And if you look at which states saw the largest quarterly jumps in overall delinquency, you're looking at Mississippi up 109 basis points, Louisiana up 89, Maryland up 87, Oklahoma up 86, and Indiana up 86. These are not the cities making real estate headlines. That's exactly why this is being missed. Now here's the context that reframes all of this. The Federal Reserve Bank of New York just published its own analysis of where mortgage delinquencies are rising the most. And what they found should change the way you read every housing headline you see. In the lowest income zip codes, 90-day plus delinquency rates have surged from roughly 0.5% in 2021 to nearly 3.0% by late 2025. That is a six-fold increase in 4 years in the highest income areas. Delinquency rates are barely moving. They remain near historically low levels. This is not a national housing crisis, at least not yet. It is a geographically concentrated, income-stratified financial stress event that is spreading from the most vulnerable borrowers outward, and the direction of travel has been consistent for 20 years. Because I want to be honest with you here, behind every one of these data points is a real person who made a rational decision. And I think it's important that we understand their story, not to be pessimistic, but because it tells us something critical about why this is happening and whether it's going to stop. Here's the profile of the typical FHA borrower in serious distress right now. They bought somewhere between 22 and 2024. They put 3.5% down, which is exactly what FHA is designed for. Their household income when they closed was somewhere around $70,000 to $85,000. Their monthly mortgage payment was probably in the $2,100 to $2,400 range. The MBA's own analysis points to something critical here. The vintage years most in distress are 2022 and 2023, when mortgage rates rose sharply and affordability was already stretched to the breaking point. These are borrowers who were approved at the absolute peak of affordability strain. But here's what didn't show up in their loan approval: what home ownership would actually cost them. Homeowners insurance, especially in high-risk states like Florida, Texas, and Louisiana, has been repricing at levels that have shocked even industry veterans. In Florida, the average annual premium is now $7,136 per year. 7 major carriers have either pulled out of the state entirely, stopped renewing existing policies, or dramatically restricted coverage zones. That's not a Florida problem. In California, the state's insurer of last resort, the Fair Plan, now carries $724 billion in total exposure, up 230% since 2022. Property taxes reassessed 15 to 20% higher in high-growth markets. HOA fees climbing 20 to 30%. And according to a 2025 analysis by Cotality, non-mortgage ownership costs jumped 30% in a single year for the average homeowner. So here's what happened to the borrower I just described. Their mortgage rate didn't adjust, it's fixed, but the costs wrapped around their mortgage payment became completely unmanageable. Escrow payments in some markets have increased 70% since 2019. In certain Florida zip codes, housing costs, mortgage plus taxes plus insurance, now represent 38% of total take-home income for the average borrower. They didn't make a reckless bet, they followed the rules. They did what they were told home ownership looked like, and the math has simply stopped working for them. Now let's overlay one more data point onto this picture because it changes the entire trajectory. On March 6th, the February jobs numbers dropped. The US economy lost 92,000 jobs in February 2026. Economists had expected a gain of 60,000. That is a $152,000 swing in a single month, one of the largest forecast errors in recent memory. The national unemployment rate moved up to 4.4%, and this was the third time in 5 months that payrolls declined. For a conventional borrower with 30% equity, that's a concerning headline. For an FHA borrower who is already stretched thin, spending 38% of take-home income on housing costs alone, watching their insurance bill go up, watching their property tax bill go up, and now watching their job market soften, that jobs report is not a headline. It is the difference between hanging on and letting go. The Federal Reserve has cut rates 6 times over the past year, 175 total basis points, and yet the 30-year fixed mortgage rate is still sitting at approximately 6%. Mortgage rates didn't meaningfully follow the Fed lower. Demand kept falling anyway. Pending home sales in January 2026 fell to near record lows. Nearly 1 in 7 home sale agreements fell through in January, a record rate of cancellations. This is not a rates problem, this is a structural problem. Here's what makes the FHA delinquency data so important. Beyond just the communities it directly affects, FHA delinquency has historically been a leading indicator for the broader mortgage market. It has been for 2 decades, go back to 2006 and early 2007. FHA delinquency started climbing in specific markets, Sunbelt metros, Midwest industrial cities, specific coastal corridors. Mainstream analysts called it contained, a subprime problem, not relevant to the overall market. By 2008, conventional loan performance had followed FHA into crisis, running approximately 18 months behind. Now look at where we are today. FHA serious delinquency rising at the fastest quarterly pace in years. Conventional delinquency still relatively contained at 2.89%. That gap, 841 basis points between FHA and conventional, is not reassurance. Based on the historical pattern, that gap is a 12 to 18-month warning. Here's the exact mechanism by which this spreads, and I want you to follow this carefully because this is how an FHA problem becomes your problem, even if you've never had an FHA loan. Distressed FHA sales hit a zip code, they pull down comparable values, lower comps reduce equity for every homeowner on that street, including conventional borrowers. Some of those conventional borrowers tip from equity positive to underwater. Underwater conventional borrowers who then face a job loss, a divorce, a medical event, cannot sell without a short sale. Short sales and foreclosures accelerate the comp erosion. The cycle compounds. In zip codes where FHA serious delinquency currently exceeds 15%, home values are declining at 2 to 3 times the rate of surrounding zip codes. That is not a projection. That is what the zip code level data is showing right now. Now, let me specifically address the homeowners in the Northeast and Midwest who are watching this and thinking this doesn't apply to me. I understand why. On the surface, your market looks fine. The Case-Shiller data for Chicago, New York, and Boston is still showing appreciation. Hartford was literally just named one of the hottest housing markets in the country for 2026. These are real numbers, but here's what's underneath them. These markets are appreciating while simultaneously losing population. New York lost over 130,000 net domestic migrants in 2025. Prices are still up 5%. That math works only as long as an ever-shrinking pool of buyers keeps paying ever higher prices. And the New York Fed's own data shows that even in these markets, delinquency in lower-income zip codes is starting to tick upward. Compare Hartford, up 21% from its 2022 peak, with Austin, which is now 27% below its 2022 peak. Those two lines are not diverging forever, they are converging. The question is not whether they meet, it is which one moves faster. The Northeast and Midwest are not immune, they are delayed. And there is a significant cost to not understanding the difference between those two things. All right, I want to give you real actionable guidance here, not generic advice, specific decisions based on where you are. If you are a seller right now, the delinquency pipeline leads foreclosures by 12 to 18 months. And that pipeline in multiple markets across this country is full. If you are in a state or a city with elevated FHA concentration, and I named those states earlier, Louisiana, Mississippi, Alabama, Indiana, Oklahoma, the distressed inventory that will compete with your listing is already in the system. It just hasn't shown up on the MLS yet. Your agent may be telling you to hold, to wait for rates to come down, for demand to bounce back. I want you to understand the risk of that strategy. Your next comparable sale may be a foreclosure, and foreclosures reset comps in ways that are hard to recover from quickly. Price to move in the next 90 days, or understand clearly that you are betting against data that is moving in one consistent direction. If you are a buyer right now, before you make an offer on any property, do this one thing first. Look up the 90-day FHA delinquency rate for that specific zip code. This data is publicly available through HUD. It takes 10 minutes. A zip code with FHA serious delinquency above 10% is not a buying opportunity right now. It is a falling knife. There will be opportunity in those markets, but it comes after foreclosure inventory crests and comp erosion stabilizes. You'll know when that moment arrives because the delinquency rate will plateau before prices do. Watch the delinquency rate, not the listing prices. Listing prices are backward-looking. Delinquency data is forward-looking. If you are a homeowner not planning to move, pull your current equity position this week. Not last year's Zillow estimate, your actual current equity based on recent comparable sales in your zip code. If you are below 15% equity in a zip code with above average FHA concentration, you need to know that number before the market moves it for you. Equity below 15% in a deteriorating comp environment is how conventional borrowers end up in the same trap FHA borrowers are already in. You cannot afford to be surprised by that number 6 months from now when your options are more limited. I want to close with something that goes beyond the quarterly data, because I think there is a structural shift happening in American housing that goes much deeper than a single delinquency report, and you deserve to understand it. The median age of a first-time home buyer in America just hit 40 years old. That is an all-time record. The share of home purchases made by first-time buyers just dropped to 21% against a historical average of 40%. Think about what that means. The people most dependent on FHA financing, first-time buyers, moderate income households, communities that were already stretched, are being priced and defaulted out of the housing market simultaneously. Entry-level home ownership is not just expensive right now. It is structurally disappearing, and it is being squeezed from every direction at once. Insurance costs that are repricing to reflect actual climate risk after decades of being subsidized at below-risk prices. Property taxes that are catching up to inflated assessed values. Mortgage rates that refuse to move despite 175 basis points of Fed cuts. A job market that is softening in exactly the sectors where FHA borrowers are most concentrated. And government relief programs that existed to catch the most vulnerable borrowers, like veterans, that have been quietly eliminated with no replacement in sight. Federal Reserve Chairman Jerome Powell in February in front of Congress, in a comment that received almost zero news coverage, said that in 10 to 15 years, there will be regions of the United States where you simply cannot get a mortgage because no insurer will cover the home. That is not a fringe prediction. That is the chairman of the Federal Reserve describing the logical endpoint of the insurance data that is already in front of us. First Street Foundation estimates that 39 million US homes are currently insured at prices that do not reflect their actual risk. When those prices reset, and they are resetting state by state, carrier by carrier, policy by policy, the payment shock currently hitting FHA borrowers in Florida and Louisiana becomes a national story. The Q1 2026 FHA delinquency data will be released in May of this year. And based on the trajectory we are currently on, the jobs data, the insurance repricing, the expiration of relief programs, the continued pressure on lower income households, that report is going to matter. There are two numbers specifically that I want you to pay attention to when it drops. Number one, whether FHA serious delinquency crosses 6% on a non-seasonally adjusted basis. That is the threshold that historically has preceded a broader market response. Number two, whether the quarterly increase accelerates or decelerates. A deceleration would suggest we are approaching a peak. An acceleration would suggest the pipeline is still building. If both of those move in the wrong direction simultaneously, and if the jobs market doesn't recover meaningfully between now and May, that is the combination that signals this moves from a slow burn to something this market is not prepared for. We are going to break down that report within 24 hours of its release with full state level and zip code level data so you can understand exactly what it means for your specific market. If you're not already following this channel, subscribe right now. Hit the notification bell. This is not content that benefits from being discovered 2 weeks after posting. The people who act on this data first are in a completely different position than everyone else. Drop a comment below and tell us what market are you watching. Whether you're a buyer, a seller, a homeowner, or an investor, tell us your market and we'll factor it into our next breakdown. Here's the one thing I want you to walk away with today. The housing market in March 2026 is being described in most headlines as stable. Elevated prices, tight inventory, mortgage rates slowly drifting lower. It looks like stability, but stability and stagnation look the same from the outside until they don't. The FHA delinquency data, the jobs data, the insurance repricing data, the pending sales data, they are all telling the same story from different angles. The math of home ownership is becoming unworkable for a growing segment of American households. And when that segment reaches a tipping point, it doesn't stay contained to that segment. It never has. The question is not whether you are in the FHA market. The question is whether you understand what the FHA data is telling you about where the overall market is headed. You do now. We'll see you in the next one.